Hi there, it's Kristen Cooper, your certified mortgage planning specialist. And today I just wanted to go over kind of where we're at in the market, what it means. There's so much coming at us and can't really look to the media a lot of times to really understand the real underlying when it comes to the real estate and mortgage industry and what's happening and how that has impact to us today. So we're going to be talking about what's the direct impact into mortgage, real estate, and kind of what's going on with the economy today. My goal, my passion, my mission is to provide education so that people can make smart decisions around money. And that's really what we're going to look at today. So we're going to dive into kind of what's going on with the mortgage interest rate market. As you probably are hearing, interest rates have gone up and are continuing to go up, and that is true. But what does that even mean? What does that look like? And to what degree is that? So what we're looking at here is just a chart of what's called mortgage-backed securities, which is one of the indicators that we're going to be looking at to see what's going on in the mortgage market. And to really keep it simplified, but show you the impact of the volatility of this market, I want to show you this chart. So what you're looking at here is if you look at the first to the left-hand side, and you can see this goes back to January, you could see on this chart that we are at a higher level on the chart, meaning we're towards the top. What that means is the interest rates at this time were lower than where they are today. So when we're at the top part of the chart, interest rates are lower. When we're at the bottom of this chart, interest rates are higher. So you can see the move that it's had from January to today and where we are at the bottom of the chart, meaning that rates have gotten higher. But what does that mean? So if you look at this chart here, you can see a per day snapshot. So it will track every single day and let you know what happened from the previous day to today, how it closed out. So what you're going to see here is if it's red, that means the interest rates were worse that day than they were the day before. And if it's green, that means that they were better. So you can see there's huge volatility. Is why I like to show this chart, because you're seeing on here that there was some normalcy in the beginning of the year, not very much movement up and down, kind of normal. And then you can see some pretty big swings. So you can see here a big drop from January to today, which had interest rates, from where they were to where they are now, 1.5, 2 points higher than where they were with the mortgage rate. And so you could see a lot of volatility in it. Now, based on what's going on right now in the economy with highest inflation that it's been in over 41 years, with where we are with what's going on with the war, where we are with what's going on with all the different Fed hikes and the interest rates, balance sheet runoffs, all of that, we are expecting, the top economists are anticipating that we're going to continue to see mortgage interest rates rise through the end of the year. So it can have a big impact for people that are looking to purchase, that need to sell and buy, that maybe are going through a divorce situation and have to do what's called an equity buyout. And so it does have an impact. So we want to look at, well, what does this mean short-term and long-term so that we can better prepare moving forward? Well, what it means is that we're heading into a recession. So if you look at all the indicators of where we are now with interest rates, and you look at some different factors and indicators that we're going to look over, you could see that we are heading to a recession. What is a recession? Well, a recession simply means that the GDP, which is what measures where people are spending money, is down for 2 quarters or more. So it means that now people are not able to, or they're not putting money back into the economy. And so now it's creating a recession. How does that mean for mortgage and real estate, though? Well, for mortgage and real estate, as you can see here, there's a couple indicators that show that we're moving into the recession, and one of them is unemployment rate. So if you look here, this tracks all the way back to the 50s of where unemployment rate levels were, and then where recessions. So you can see this dark line here that shows recessions, and you can see the unemployment record here. So this is one of the indicators that shows that, yes, we are heading to a recession, because as you could see, when unemployment goes up and then it comes back down, well, then we hit a recession. Goes up, comes back down, well, then we hit a recession. So you can see here that unemployment had went up, and then now it's come down to a great low, which is great that those numbers are there. But when we start seeing it trickle back up, which is kind of what we're starting to see, if you look at different numbers, we are still at a low, but we are going to see that continues, or that starts to shift, as people are going to have to start laying off people because they need to hold more of their earnings in the business companies because things are more expensive. And when that happens, then it's a trickle down effect to where people are being laid off. Well, now those people that are laid off are spending less, which is less money. And when there's less money, it continues the cycle. So when we see that unemployment rates are low, when that starts to tickle back up, which we're seeing some indicators, is when we hit recession. But what does that mean to housing and mortgage? Well, as you can see here, if you look at the housing stays strong through recession, if you look at this house price index, you can see here that all the way back from the 60s, every time we hit a recession, which is the dark line that you're seeing here, housing continued to rise. So housing stays stable through recessions. The only time that we saw a dip was back during the crash, which was, caused by oversupply and bad loans. We don't have oversupply. We have undersupply. There's not enough inventory. We are at the lowest point of inventory that we've been in a long time, especially with builders not being able to build out enough and not having enough inventory to turn over. So as you can see here, with all of these recessions, housing continues to be stable and increase. Why is that important to know? Well, a lot of people are really concerned with, what's going to happen with home values? Are they going to go down? Well, it's supply and demand. As long as we have low supply and low inventory, we're going to continue to have a demand for housing. So it's going to continue to keep homes at the levels that they are stable and appreciating. Now, hopefully we're not going to continue to see double digits, and they don't expect that we will, because it can't be sustained, but we will see appreciation still continue to move forward based on all the top economists and all of the stats and trends that you're looking at. So what you're seeing also is, what's going on with the market and where everything is going. The only way to really hedge inflation for investors too is to diversify and put more money into real estate. Housing is a long-term sustainable appreciation measure. If you look at over the last 30 years, and even take into account when we had the 2009 crash, we still continue to have an average appreciation on homes, not to mention still need housing if it's your primary residence too. So people are moving into real estate. And so it's really important to know that your real estate is not going in a bad direction with everything that's going on. It's going to continue to be stable moving forward. And it's still one of the best investments that you can make. Really building it as one of your pillars to diversify your portfolio so that you can build a real estate empire that's giving you cash flow and income is a great sustainable model for future income and retirement income as well. So as you can see, home prices are continued to forecast. You look at all the major, you have Fannie Mae, Freddie Mac, MBA, all of these are that measure what their expectations of what they think the homes are going to continue to appreciate through the year. You can see all of them are appreciating that, or seeing that we're going to continue to appreciate, and most of them over 5% and above that. So really making sure that when you are looking into real estate mortgage options, you're working with an actual mortgage advisor and a certified mortgage planning specialist, which is what I am as well. It's really important to make sure that you're getting the right structure in the financing and the market. Understanding where the market plays a huge role in the way that you're going to structure any type of financing when you're buying real estate. And the reason that I show that is there's a couple different things that you want to take into account when you're getting a mortgage. Is where is the market now? Where is the market going? The other portion, when you have inflation or when you have a recession, is housing stays stable and continues to increase, mortgage interest rates drop. So whereas right now we're seeing mortgage interest rise, in the next 1 to probably 3 years when we hit a recession, we're going to see that, again, housing stays stable, but interest rates have to come back down to get the market stimulated, get people to start spending again, and help people start saving money, both with purchasing, but also people that currently have loans. Now, a lot of people have a really good interest rate from when the interest rates were lower before. However, didn't take into account all the debt that they had and or are currently accumulating because of the cost of things going up. I mean, look at our gas prices. A lot of people, that's a huge impact. I know my husband travels to work, and it is a big commute, and so it is a big impact on when gas prices go up into the spending budget. So you didn't anticipate that those expenses were going to be there and things were going to cost as much. So it's likely that a lot of people are having to use credit cards, maybe don't have a family budget set up, so they're not properly spending their money in the right places, and so they're accumulating debt. So for people that have a great rate, you want to explore different options in this market of, okay, maybe you're at a place where you really are not comfortable in your finances and you're having to use credit cards and you don't have enough money. Well, you want to be smart. So if you already have a mortgage, you want to look at, okay, is there a way for me right now to save? In this type of market where things are going up and costing more, we really want to look at, is there a way that I can save more money and that I can make my finances work for me? So you may already have a low interest rate right now, but now you have all these debts and interest rates are higher. It may still make sense for you to do a low or no cost refinance now at a higher rate, consolidate all your debts, pay all your debts off right now, because as I just said, when a recession hits, which is expected in the next 1 to 3 years, and rates drop back down, you can then refinance your loan again then to come back down to a lower rate. So what it would do is free up a lot of cash flow for you right now. So as you can see here, this is just a basic instruction or demonstration of showing you if somebody that has a current loan at a 3.5% interest rate, but as you can see, they have quite a bit of debt that they need to pay off and consolidate. So they have about $45,000 between installment and credit card debt. Now that home prices have gone up so much, they have equity to be able to pay those off in a refinance. So they pay off their current loan, they pay off all their debt. You can see right now with their current mortgage at 3.5% and all of their debt payments between their installment and revolving, their outgoing expenses just for their mortgage and their debts is about $2,500. Now, if we were to consolidate and pay those all off in a refinance based on this scenario, of course, we'd need to look to see if you qualify and what your rates and all that would be. But if you see in this scenario, well, now they paid off all their debts and their total outgoing is only $1,631 a month. Now, their mortgage before was $1,083. So at first glance, you would think, oh my God, my mortgage is going to go up $600 a month because my rate is so much higher. However, again, we're thinking smart and creating a mortgage plan that's going to work for you. So if you end up paying off all those debts, well, now your total payment $1,631. This is where you're going to have, a $878 monthly saving cash flow. This is where we get strategic. This is where we take back control over our finances and say, okay, let's create a family budget. Let's sit down and figure out what our actual outgoing expenses are that are mandatory, how much money we have coming in, create a solid savings account, meaning that you have money set aside so you don't have to use those credit cards anymore or rely on those when an emergency comes up. Then you can continue to pay more towards your mortgage. So since you're saving $878, maybe $200 of that savings you can reinvest back into the mortgage so it starts paying down that balance so you're not just including the debts into the mortgage and leaving it there. So by reinvesting some of that savings that you have, it's going to bring your loan balance down so that you're not just using your mortgage equity to be able to consolidate the debt. You're using it as a tool to consolidate all your debt, get all your finances back in order, and put you in a better position. So I go over these mortgage strategies with my clients so that you understand how this works. We don't want to refinance and use all the equity and now you're back to square one where you lost all the equity that you gained. We want to use it as a tool to structure you saving more money. And that means taking control of your finances and using it as a tool so that it could put you in a better position. Because as you can see, if you were to reinvest how much you saved into this, well, now you could potentially pay this mortgage and all the debt off in 12.7 years by reinvesting the savings that you had. So we could look at those options too. But that's just one scenario. So what does that mean in the future? And why does this make sense now? Why would I give up my low rate to go in a high rate? Because as I said, we're heading towards a recession, which means during a recessionary period, mortgage interest rates fall back down. So maybe you take out a higher debt loan, which is the scenario we just had at a higher rate, and your payment went up to $1,631. But in the future, if we're able to get that rate back down to 3.5, well, now your monthly savings goes back down to $1,373. Mind you, you started with $2,500 in your outgoing expenses for your mortgage and your debt. All your debts are paid off, your mortgage is paid off, and now you're going back into a lower payment. Of course, beyond that, we have the strategy call and we discuss, okay, based on what your term was that you were going to pay off your mortgage before, maybe you only had 20 years left on it. What do you need to pay on this new loan with the lower rate to pay back off in that time frame if that's what's important to you? Or how do we take this monthly savings and reinvest it into something that's going to give you a greater return so that we end up in a better financial position? We're not using it as a crutch. We're not using the equity just to pay off debt and then be in a worse position. We're putting you in a better position so that you save money long term. This is how a higher interest rate market can help benefit you in the future when we're heading towards a recession. So what can you do to protect your wealth in this market? Well, create a family budget. Step one. So as a mortgage advisor, I'm very passionate about financial education and literacy. I've created a lot of courses and programs to help my clients be in a better position. So you want to create a financial budget. If you don't have one, then I highly encourage you to take my course. You go through the six steps to create financial freedom and wealth, and it'll show you the basic things that you need to do to be in a better position, to take control of your life. You can be in a better position if you do the work and you follow the course and you look at the information. Consolidate your debt and save, just like we went over, whatever position. And maybe you don't have that much debt, and maybe you have a 401k that you could take a temporary loan from that has better terms than your credit cards, and you can take that 401k loan, pay off all your debts, keep your credit cards open, don't close them, it will hurt your credit, but pay off your debt. And then you have your 401k loan that you could start paying what you were paying towards your 401k and get it paid off sooner, maybe because your interest rates are lower than they will be on credit cards. Because as the Feds increase rates, look at your credit card statements. Those are going up and they're going to continue to go up. We've got to take charge and we've got to get into a position to where we can lower the interest into a fixed interest to where we have a plan to get them paid off sooner so you're not just paying minimum. So you want to consolidate your debts and save. Then you want to create and implement a financial plan. Again, it starts with the family budget, but then you're going to go through an entire financial plan of where do you want to be? What's your plan to retire? Do you want to save for your kids' college fund? What's your savings plan look like? Do you have an emergency fund? All of these are very important things that we need to know and understand to make sure that we're in a good position in any type of market so that we're not in a bad position moving forward. So you can give me a call. Let's look and see if we can utilize your mortgage to consolidate debts based on what we just went over and see if it makes sense, or maybe come up with some other alternatives. Maybe it doesn't make sense, and I will be happy to tell you it doesn't make sense, but we want to look at all options. Then take control of your finances. So you can start with the course. I'm going to go ahead and give you access to it. You can see here, and it has the password so that you can go in and you can follow the course. The biggest thing is that you really need to commit. If you're in a position that you're not happy with your finances, you're not happy with your wealth, then I encourage you to make time, put this on your calendar. If you watch this and you don't do anything with it and you're in a position that you don't want to be, it's going to stay the same. You got to take the action and you got to have the discipline to do the work. Put this on your calendar. It's 6 short videos that help you get the education, the resource. It even provides the tools and the resources within it so that you can be in a better position. So if nothing else, create your family budget, watch the family financial plan and wealth so that you have the information to be empowered. My goal is to give you the information and resources to make good decisions with your money. If you have any specific questions, please reach out. I want to be of service to you. I want to be able to help. My goal is to help our community be better with money, create generational wealth, and be in a better position so that we don't have to live stressed from money, which most people and most Americans are today. So again, Kristen Cooper, your mortgage advisor and mortgage planning strategist. If you have any questions, please reach out. Happy to help.